Hello, everybody. Sorry about a little bit of a delay there. Who'd have thought that time savings or the spring forward would give us some IT issues on this kind of thing. But anyways, I'm Joe Lucey. Most of you are probably familiar with that. I am co-founder and CEO of Secure Retirement. Joining us this week on this week's Market Huddle, Andy Ives, certified financial planner. Most of you are probably familiar with Andy. He's been on several times. He is one of the subject matter experts with that Slots organization, here to share some insights with us, specifically around required distributions. Why is this topic important? Well, last couple times we've done this, we get a lot of questions. What is RMD stand for, and how do they work? And so anyways, we're going to get into the weeds a little bit this week on our Market Huddle. We're going to dive in with one of America's experts around IRAs and required distributions. And boy, without any further ado, Andy, welcome to this week's Market Huddle. Thanks for joining us.
Yeah, thanks for having me. I appreciate it. And yeah, this is amazing how topical this is. I literally had a question last week with my own parents about required minimum distributions and how they work. So yeah, the fact that some people brought up some questions last time about this, it just seems totally applicable and appropriate to have this conversation. So there you can see the topic there, what you need to know about required minimum distributions on that first slide. And I'll skip it ahead here. I don't know if you have to say anything about this, Joe, anything?
Here's our standard disclaimer, short and sweet, that says that I don't work for the government, and any of the tax type discussions we're having here, we're going to remind you should probably check in with the CPA or your CPA, your chartered, your public accountant, whoever's doing your tax returns, get them to interpret any tax code here. And, if we talk about anything around estate planning, maybe bringing it together with an attorney may not be a bad idea, but that's what this pretty much says. So let's move on here. And, Andy, I'm going to hide my video here. You can stay on for a while, but why don't I kind of turn it over to you? Let's talk about the critical retirement planning decisions that have to be made around RMDs.
Yeah, and there's the four things I'm going to hit on. So first bullet point says, what is an RMD and why do I have to take money out? And we're talking about taking money out of IRAs as well as workplace retirement plans like a 401k. So we'll talk about that. The required beginning date, a lot of confusion around when that date is and when you actually have to start taking required minimum distributions. And there's actually been a change just recently with the Secure Act as far as that age. So we'll talk about that. We'll get into how to calculate your RMD. That's the conversation I was having with my parents last week. That's how you do the math around that. And then I'll touch on some ways to potentially minimize or even delay taking a required minimum distribution from your accounts. So as it says, the first one there is, what is an RMD and why do I have to take money out of my IRA? So the rationale is basically you are allowed, if you put money into a traditional IRA, you get a tax break on the front end. That money doesn't count towards your income. But to be able to have that tax break, the government says, we'll give you that, but you got to start taking money out at a certain time in the future. So that's why you have these forced distributions. Same thing with a plan. If you have like a 401k, we'll allow you to defer money into your 401k. We will not count that as earned income for the year. But when you get to a certain age, you're going to have to start taking money out, and that's the required minimum distribution. The rationale and the philosophy is, hopefully, and we'll get into this as well in the future on another slide here, as far as the tax brackets, how you can maybe save some money and how that's a benefit to use an IRA and how it's better. Some people say, well, if I'm paying tax, I'm paying tax later, it doesn't matter. It could potentially matter. You might be in a lower tax bracket, and I'll touch on that. The next bullet point says lifetime RMD versus inherited IRA RMD. So lifetime RMD is just what it says. It says while you're alive and you have this particular account, if you've been saving money into like a 401k or an IRA, you ultimately will have required minimum distributions from that account. The same holds true for an inherited IRA or an inherited account. If someone were to pass away and they give that IRA to the next person in line, say it's, they give it to their son, their adult son, that adult son just can't leave it in there forever. That adult son would potentially be required to take required minimum distributions off of that account as well. So be aware that it's not just to the IRA owner once it moves on. And that's even applicable to a Roth IRA. I know I've had arguments with some people to say that no, there's no RMDs on a Roth IRA. That's true. There are no RMDs on a Roth IRA while you're alive, Reason being is you didn't get any tax break up front. When you put money into a Roth IRA, when you're funding a Roth IRA, it's after tax money. You don't get any tax breaks. The break is that those earnings go tax free. But because you didn't get a tax break on the front end, because you put in after tax dollars, there is no required minimum distribution on a Roth IRA. But in the event of your death and you pass that to your beneficiary, if it's a child, let's say, that person is going to have an RMD off of that inherited Roth IRA. So just be aware of that. They're applicable both to while you're alive and for the beneficiary. As it says in that third bullet point, is applicable to IRAs and work plans. I mentioned that. And the bottom bullet point is what I was alluding to earlier, hopefully in a lower tax bracket now, but not always the case. Now, meaning when you're taking the required minimum distribution. So again, the rationale or philosophy is in your years when you're working, when you're earning, you're making more money. So you have the ability to put this money into an IRA. You have the ability to take a tax. You want the tax break while you're in your earning years. And then the thought process is that's after you retire, you're now in a lower bracket potentially. Maybe you don't have as much income. So hopefully that RMD won't be as painful when you have to take it in the future when you're retired. Not always the case, though. Some people do find themselves in even a higher bracket. And who knows what's going to happen to the tax brackets? We've heard all these rumors and rumblings about how taxes have nowhere to go but up. So if taxes are super low right now, maybe in 10 years when you have to start taking RMDs, if you're only 60 or 62 right now, maybe the brackets are going to be even higher. So you never know what's going to happen in the future. It says on there, tax increases in the widow's penalty. That's one that can sneak up on you. So a couple that is a married filing joint, the brackets are a little bit different. And if one of those person were to pass away, you have the widow's penalty. And I've got my tax bracket charts over here for 2022. And it shows that the marginal tax bracket. So if you're married filing joint, if you're in the 24% bracket, that's 178,000 to 340,000. That's a big window, pretty high, 178 to 340. If one of those spouses were to pass away, the same 24% bracket for a single filer is in the only 89,000 to 170,000. So it's much lower. So if you have a widow that is now taking RMDs and was taking RMDs when they were married filing joint, now you're in you're taking all that money while a widow, but you get to the 24% bracket a heck of a lot quicker. So you might be in a higher bracket with that quote unquote widow's penalty. So anyways, moving on, this is the thing that causes the most confusion when it comes to required minimum distributions. People understand they have to take the payment out. They have to take their distribution, they have to take their withdrawal when they get to a particular age. But when does it start? It says that it was 70 and a half and now 72 with the Secure Act. That age 70 and a half was totally confusing. Some people turn 70 and a half in the beginning of the year. Some people turn 70 and a half at the end of the year. When would it start? That is no longer the case. With the Secure Act that was passed a couple of years ago, we are now age 72. And we're a couple of years into the Secure Act. So basically we've cleaned out any of those people that were right on the borderline of turning 70 and a half or turning 72. Now just look at 72. It's the year you turn 72. That's the first thing we want to look at. So I'm going to move my cursor around here so you can see this. The RBD, the required beginning date, is April 1 of the year after turning age 72. So it doesn't matter when I turn 72 during this calendar year. If I turn 72 in January or if I turn 72 in December, doesn't matter. This is my first year of an RMD, and my very first year, and only for my very first year, am I allowed to delay that payment until April 1 of the following year. So this April 1 right here, that is the official RBD, or required beginning date. It is April 1 after the year you turn 72. Now, it says in this third bullet point here, only the first RMD can be delayed. My guess is that the government says, listen, for people that are turning 72 this year, they might not know they have to take an RMD. We're going to give them a little bit of wiggle room. So we'll give them a couple extra months here. So that's why you get to delay that first one. If you delay it, and some people want to delay it, they want to push it off as long as they can, that's fine. But if you delay it to this part of the next year, you're going to have to take 2 RMDs in this year, because you've got to take the one that you delayed plus the one for age 73. So be aware of that. It's going to double up the payment for this year which is going to certainly increase the amount of income that you have for that year. So you don't have to delay it. You can take it whenever you want in this calendar year of 72, but recognize that the very first one can be delayed. In this second to last bullet point, if you miss it, if you refuse to take it, if something happens and you don't take that required minimum distribution, the penalty is one of the steepest penalties in the tax code, 50% of what was not taken. Now, there are ways to fix it. We do have, and the IRS is pretty agreeable. We've got a little form that you can fill out. There's a letter you can send in on your taxes. We've got it all nailed down as far as how to quote unquote fix it, but it's best to avoid that altogether and just take your required minimum distribution. The word required is there for a reason. You got to take it. I mentioned earlier that Roth IRAs have no RMDs, and that's the last point there on that page, because you already paid the tax. When you put the money in, it was after-tax dollars. The benefit of a Roth IRA is all those earnings go tax-free. So once again, I'll just emphasize one more time. RBD is April 1. In the year you turn 72, it is April 1 of the year after when you have to take that first RMD is the absolute deadline for the first one. Okay. Yeah, go ahead, Joe.
Andy, well, I was just going to suggest, does anybody have any questions that they'd like to ask so far on this? Otherwise, we can take the questions at the end. I know Cliff had raised his hand to try to ask a question a little while ago. If you just type it into the chat, that would be easier for us to see there. Okay. An interesting thing here, Andy, is that while RMDs or Roth IRAs have no required distribution on our own contributions, keep in mind that the beneficiaries, I guess they aren't required distributions anymore with the Secure Act. They actually still do have a schedule that they have to take that money out when they inherit. Our children would have to inherit and follow those, correct?
Yeah, that's absolutely correct. And Joe and I were talking before we came on live here. The IRS released regulations, Secure Act regulations, 275 pages, additional guidance on the Secure Act. Just came out a couple of weeks ago. And there's even more regulations around RMDs as far as when the person passed away, the original IRA owner, how old were they? Were they taking RMDs? If they were, that could dictate even more RMDs off of a Roth, meaning within the 10-year rule, Joe, which we've talked about in the past, but I'm not going to get into the weeds on that. But yeah, absolutely be aware there are RMDs on a Roth IRA for the inherited beneficiary.
With that said, I see Kurt has a question, but he's kind of a good segue to the next slide. So why don't we move on to the next slide, which is, well, how do we calculate these things so we don't have to pay this 50% penalty?
Yeah, good job, Kurt. Kurt's he's like a plant out there. That's perfect time. So here's how we do it. You know what? I'm going to go back. I'm going to go back one slide. I'm going to look at this right here. So I'm going to point back to here. So age 72, this is the magic year when you would have to take your first RMD. I'm going to allude to December 31st of the previous year. So I'm going to allude to right here, December 31 of this 1 year before when you turn 71. So that's
I'm not sure I can see your slide there.
This one right here.
Does my mouse show up on this?
No, I don't see it. Well, I thought you might be able to see my cursor on here, but what I'm looking at is that age 72, that year basically. We're going to look at the December 31 of the year before that, and that's here on the next slide. So use December 31 balance from the previous year. So we'll use that age 72 year. In the year you turn 72, we know that's your first year of taking an RMD. We know that you can delay that first RMD until April 1 of the next year. But let's just say hypothetically, person doesn't want to delay it. They're just going to go ahead and just take it in the year they turn 72. They look at the December 31 balance in the IRA from the previous year. We're always going to use the December 31 balance from the previous year. That's the number that we're going to use. Now, we have to look at a table, and I've got something here called the Uniform Lifetime Table. This is just a table of life expectancies that has been created by the IRS.
And this is something we can share with everybody after the presentation. If you'd like to see that, just email us at info@securedretirement, and we'll get everybody a copy of these tables.
Absolutely. Now, it shows on here this page that there's 3 different tables: uniform, joint life, and single. I'll talk about those. The uniform life table is the one that most people use because it's the easiest one. You just simply look up your age. So in this one, the very first number is 72. The corresponding life expectancy for 72 is 27.4. So all you do is you take 27.4 and divide it into that 1231 balance. So whatever that IRA balance is, divided by 27.4, that's your RMD. The next year, you have your 1231 balance for the next year. The next year, you look up age 73, the corresponding life expectancy factor, 26.5. You simply divide the 1231 balance by 26.5. So it's just basically you go back to the chart every year, get your life expectancy, and divide it into the 1231 balance of the previous year. That's it. That's how basic it is to fill out or to calculate an RMD.
Is it okay, Andy, if I jump in just for a minute or two?
Yeah, jump in there.
One thing here is, and Kurt asked a couple questions here.
Mm-hmm.
One, he asked about, does the lifetime table change and how often? I think that's actually a fairly timely question as well. So how often, or when's the last time they made a change to these RMD tables, Andy?
2003. Yeah, actually, that's interesting because I think we should be paying Kurt here because that's another perfect question, because this is a brand new table just released for 2022. They just changed for 2022, but they had been in existence for 20 years. So basically, these new tables add about a year, some places a little bit less, sometimes a little bit more, but they add a little bit of a life expectancy to people's ages. But it's a good question. They don't change very often. So it's been 20 years since the last one came out. Let's see here. So the other question Kurt had was, when do you calculate it? You can calculate that anytime during the year. 1231 balance and the life expectancy number are fixed. So you can calculate that anytime during the year. I did want to mention the different tables on here. So I mentioned the uniform table. People use that most common. The joint life table. If you and your spouse happen to have a age difference of more than 10 years, you use something called the joint life table, and then you would use both ages. So, for example, let's say you turn 72 and your spouse happens to be 60. You can go to the joint life table, you find both ages, 72 and 60, and you bring them together, and you're going to get a number. That number is actually going to be higher than what's on the uniform life table. The uniform lifetime table essentially assumes a 10-year difference. So that's why if you looked up 72 and 62, you would get this 27.4 number. But the uniform life table is just using one age. Joint life, if you have an age difference of more than 10 years, you can use that, and it'll reduce the RMD by a little bit. The higher the life expectancy, the lower the RMD. But again, joint life is only if you have an age difference of more than 10 years. You will see references to the single life table. You do not use that during lifetime RMDs. I've had a conversation with a person that he had been calculating his RMDs every year using his uniform lifetime table, and then his wife passed away. He said, do I switch to the single life table because I'm now single? No, you do not. You always use a uniform life table or the joint life table if you have a spouse more than 10 years difference. The single life table is only for those RMDs for a beneficiary. So I wanted to get back to where I talked about how you have RMDs, a beneficiary who inherits an IRA account and has to calculate RMDs. That person will not ever use the uniform life table. That beneficiary will not ever use the joint life table. That beneficiary will use the single life table. So a couple of variables there, but just recognize that during lifetime, most people use uniform. If you happen to have a spouse that's over 10 years difference, you can use the joint. It says there, identify the appropriate factor. We talked about that. That's simply off the table. You look up the age and you get the factor. Divide the factor into 1231 balance. Now, here is another thing where people can get sideways with the rules. The aggregation rules, be careful. And I'll give you another real life story. I had this conversation with my parents. Not making this up. It's a true story. Both of my parents are over age 72. Both of them are taking required minimum distributions from their IRAs. And my dad said that, well, our advisor just goes ahead and takes both mine and your mother's RMDs from my account. And I said, I hope she doesn't do that because that's not allowed. Fortunately, she was not doing that. My dad was misinformed. You cannot aggregate two different people's RMDs. If you and your spouse are both over 72, you have to take the RMD from your own IRA. You can't add them together and take them from one. That's one thing to be aware of. Where you can aggregate IRAs is if you have a different IRA at different banks or different custodians, for example. So if I have an IRA with Bank A and an IRA with Bank B, I can calculate my RMD for each one of those IRAs. And then if I want to, I can take it all from one or whatever difference I want to take from each. I can certainly do that. You just have to make sure that you take the full RMD from someplace. So be aware of that. Be aware that you cannot aggregate like a 401k plan and an IRA. So if you have a 401k that where you used to work and you've got an RMD on that 401k plan and you've got an IRA, you've got to calculate the RMDs for those two accounts separately, and you've got to take it separately from each one of those two different accounts. So the aggregation rules can certainly get people into trouble. Hypothetically, let's say I did have a 401k that had an RMD and I did have an IRA with an RMD, and I mistakenly thought I could aggregate those RMDs and take them all from my IRA. And I did that. What would I have? I would have a missed RMD from the 401k. And now I've got that potential 50% penalty on everything that I didn't take. So it could be hefty. So be careful when it comes to RMDs. When you get to that age 72, make sure you know the rules of which table to use, how to calculate it, and where am I allowed or not allowed to take that RMD from.
Andy, is it okay if I kind of walk through, it's a hypothetical example, but let's pretend that somebody has $1 million set aside in their retirement account the year they're turning 72. So we go back to December 31st of 2021, the day before this calendar year, and they add up their balances and to the penny, $1 million. Now, if it's all in IRAs, I take that $1 million and I divide it by 27.4, and I'm going to get a number close to $36,500.
Mm-hmm.
If I have it all in one IRA, I can just take it from that account. However, if the account is set up as 500 into an IRA, 500,000, and 500,000 into a 401k, well, then the math is still the same. It's $1 million divided by the 27.4 to get 36,500. But now I need to take 18,250 out of each of the different accounts separately. So that's really what you mean by the aggregation rules.
Mm-hmm.
If I were to throw a spouse on there, we got to keep our spouse's distribution separate from our own. And that very first year, I actually have, like you said earlier, until April 1st to take my required distribution. But if I do that, well, I'll have to take 36,000 over 2 years, twice in next year. So maybe it makes sense to take the 36,000 before December 31st. So it hits this tax code, because next year and you're going to have to take it again. So we can walk through all the different examples, but what I'm trying to do here is just illustrate how the math would work for somebody at age 72. You take $1 million or whatever the IRA balances are, December 31st, what is that, 3 months ago, divide by 27.4, it'll give you your number. And then we just have to make sure we're taking that amount that is needed to be taken out to avoid the 50% penalty from the correct accounts.
Think about that. 36,000. If you miss that RMD, $18,000 penalty. That's crazy. So it can be super penal. And then the next year, obviously, your balance will change a little bit. Maybe it's $1.1 million. Maybe it's a little less. You're going to have a little bit different life expectancy. When you're 73, it'll be 26.5. But it's going to be ballpark, probably 36, 37, 38 grand again the following year. But yeah, if you delay that first and you're looking to take in your $36,000 for the first year, and then you got to take the other 30 plus, whatever it's going to be the following year. There's a question that came in here. Is it, can you shift?
I was going to say, let's move on to the next slide, and it'll start to answer, or at least it'll give us an idea of how to best answer Kurt's question about shifting money from an IRA to a younger spouse to try to avoid RMDs. So this last slide, or second to last slide, we wanted to talk about were ways to minimize or delay your current and future RMDs.
So you can't, you can't switch money from one spouse to the next. You can't just say, hey, I'm 70 years old, I don't have to take RMDs in a couple of years. Hey, my young spouse, here's 100 grand to put into your IRA. Can't do that. There's a lot of people. One thing people have tried to do is, well, what if I take all my IRA money out in December and I roll it over and I put it back into my IRA in January? That way, when they look at my 1231 balance, it's zero. That won't work either. The IRS says that any money that's out on rollover or transfer, you have to add it back to that 1231 balance. So you can't kind of game the system by having a zero balance. So all these different things have been attempted, but there are some ways to go about trying to lessen the impact of that. Roth conversions is on here. We said earlier on, there are no RMDs on a Roth IRA. So if you want to start doing some, incremental conversions, some partial conversions, if you want to convert your whole thing all at one time, you certainly can do that. But obviously, any Roth conversions would be taxable. So you're paying the tax on that. But once that money goes into a Roth, you will not be forced to take any RMDs on that account once you hit RMD age. So that's one way to minimize or reduce or eliminate RMDs. The next one says qualified charitable distributions. I know we talked about that here a couple of months ago. You have to be 70 and a half to do a QCD, qualified charitable distribution. The money goes straight from the IRA to the charity. You can't take it out and then write them a check. It's got to go straight from the IRA to the charity. But what's nice is, let's say hypothetically you have an RMD of 10 grand and you want to give $10,000 to a charity. You can do this QCD. $10,000 will go to the charity, but it does not count towards your income for the year. If you had an RMD and you took the 10 grand and did not do a QCD, you just added $10,000 to your earned income for the year. If you do a QCD, it does not go into your earned income. So that's one way to minimize the hit. I know people will certainly use a QCD to offset all or a portion of their RMDs. The next bullet point is interesting. And now this assumes that someone is insurable. You can certainly draw down your IRA. If I have a traditional IRA, let's say I'm 60 years old, and I know that I'm going to get dinged with RMDs in 12 years, I can certainly take distributions from my IRA. There's no penalty on that because I'm 60, I'm over 59 and a half. It's going to be taxable, most likely. And then some people will use that to maybe buy life insurance. So they'll be able to essentially lever up, so to speak, the amount of money that they're going to leave to their beneficiaries. And life insurance is tax-free. And there's no, while the person is still alive, 72, 73, 74, I might have this life insurance policy. There's no RMDs on that. So that's a planning opportunity that some people will take advantage of. And here's an interesting one, the last one on there, the still working exception. That only applies to plans. So we've talked about the 401k and the IRA. A plan can have a feature on there called still working. If you're still working, if you're 72, 73, 74, 75, you do not have to take an RMD from that plan. That required beginning date that we talked about being April 1 of the year after you turn 72, if you've got money in a 401k and you're still employed and you're still working there, that required beginning date is pushed out until the year after you retire or separate from service. So I do know that some people that have had an IRA, maybe they're 73, 74 years old, they've got a big IRA, they will roll it over into a 401k. 401k will accept rollovers, they'll put all their money into their 401k. They're still working, there is no RMD on that money that's in the 401k. And there's no money left in the IRA, so there's no RMD there, and they can delay any RMDs on those dollars. So there's definitely some ways to do that. I want to make one point because I skipped over this, but I want to hit it. That first bullet point says Roth conversions. You can do Roth conversions after you hit the RBD, the required beginning date. So once you're taking required distributions, you can still do Roth conversions, but you've got to take your RMD first. That's a popular question. Can I take my RMD and then convert it to a Roth IRA? You can't do it. And I'll use my parents as an example. They have to take whatever the required distribution is. Let's say it's 36 grand. They can take their 36 grand RMD, whatever it is. Everything above and beyond that, they can then do a Roth conversion, but you've got to take the RMD out first. So I'll be aware of that as well. Let's see here.
How about if I answer Tom's question and then can jointly answer Cliff's? But
okay.
So Tom, I think that your question had to do here with if you put money into an annuity and a distribution from that annuity, will it qualify as a required minimum distribution? The answer is it depends on how the annuity was funded. Mm-hmm. If that annuity is funded with brokerage money or what we would call, non-qualified after-tax money, maybe you wrote a check out of a checkbook or you took it from mutual funds that were paying interest and such that you were trying to avoid. Money that's non-qualified does not have a required distribution. However, money that gets funded with either an IRA or because you were setting aside money in an IRA or a Roth IRA for that matter, that money is what they call qualified money. Qualified money still has to be calculated in your required distribution. So back to my example from a little while ago, somebody that had $1 million, let's say it's all in an IRA, and they took that 401k because they didn't want to be paying required distributions separately from that. They roll that 401k into a IRA annuity. Well, now that that individual or that family could take that $1 million, still the same 36,500, and they could take that distribution from either of the IRA accounts, the annuity, or they could take it from the other brokerage IRA that they have. The reason I'm bringing this up is a lot of times families might set aside an IRA. They might be taking an income withdrawal or some kind of distribution from it. If it started as an IRA, those income distributions do count towards your required distribution. The one thing we got to keep track of, though, is if we're going to do a Roth on top of those distributions, let's make sure that the RMDs have been taken out first. If you have a $10,000 distribution, we need to make sure $10,000 comes out of that account before we did a XYZ, a $30,000 Roth conversion or something like that. I don't know if that answered the question, Tom. If you want to give me a thumbs up or a yes, then that would be great. But if your money in the annuity is in a IRA when it gets funded, or you make a contribution, the $7,000 a year that a retiree can put into there while they're still working, that didn't make sense. But either way, as somebody over the age of 50, then those IRA monies do have to be calculated as part of
the
RMD, yeah. And yes, they have to satisfy the RMD rules without that 50% penalty.
Yeah, hopefully. That's right. I look at it just as under, is it an IRA annuity? Is it under the umbrella of an IRA? Then yeah, that's going to have an RMD on it. And there's so many different nuances. Like I know some people will buy like a property in their IRA. They'll have a house or something like that. And you can do that in an IRA. Well, guess what? A house isn't very liquid. If you have an RMD, you can't cut the porch off and take that as an RMD. So people get into all kinds of problems when it comes to RMDs that they don't have any liquidity. But an annuity is another issue where, yes, if it's an IRA annuity, absolutely we'll have an RMD as a qualified dollars, as Joe was talking about.
And then if I can address Cliff's, and then you can add to it,
Yep.
The qualified charitable distribution, Cliff, one of the advantages of taking your RMD and putting that directly to a charity, meaning it can't go into your checkbook first. It's got to go directly to the charity. It's got to be a 501c type charity. It can't go into like a donor advised one. It actually has to go to the charity. It allows us to keep our adjusted gross income down. By keeping that income down, we can, in some cases, reduce the amount of Medicare premiums you're paying if you're paying that excess income related to Medicare adjustment amount numbers, the excess income wages that create this additional premium. So that's one of the reasons many of our clients are using qualified charitable distributions, and really something that would maybe make some sense to sit down. Let's show you how you could do that in your own situation, Cliff. So you can see how we can take advantage of that. So last question here from Kurt is I
know that answer. Answer. So,
go ahead.
So basically, Kurt's asking here if talked about Secure 2.0 and bumping the RMD age to 73. We're still locked in at 72. There is rumblings out there, and I hope they don't do it just because it's going to make life a mess for a lot of people, about basically staggering the age and slowly increasing it maybe to 73 or 75 or 76 over time. If they do that, it's going to be a mess because so many people are going to be under different rules as far as, well, how old are you? And how old were you at the time of the rules were this? So yes, there is rumblings that they could increase the RMD age, but currently it is dialed in and locked down at 72. So no changes there. Yeah, I'm just looking through the questions here. Everything.
Yeah. I think we got all the questions. How about if I wrap up a little bit here, and if somebody else has a question, we can try to address that. Okay. I wanted to give you some dates of some upcoming events. So keep in mind that if you would like to schedule some time to visit with us, I'm going to make that available for you here too. So you should see a link at the bottom of your page there that you can schedule a review or a phone call. So if you want to do that, we can talk about your own situation personally. But next couple events we have coming up. On the 21st, we're going to have actually a really timely visit. I'm going to have Nate Zeller talking about the upcoming Federal Open Market Committee. That's where the Fed probably, it at least appears as if they're going to be raising rates. We aren't sure if it's 25 basis points or not, obviously with everything going on with the price of oil and groceries and what have you, interest rates, taming of the interest rates, taming of the inflation by raising interest rates is something that everybody's pretty much expecting. It might be one of those worst kept secrets. But anyways, Nate's going to come on right after those federal meetings on the 15th and 16th, and we'll be talking about what that means for you in your retirement here on March 21st. You want to make sure you join us on that one. On the 28th, I have David Ness. Many of you have visited with David Ness. He's one of the partners there at Fafinski, Mark and Johnson. He's a shareholder and the estate planning. He runs the estate planning department out there. He's going to talk about something we also get a lot of questions on. A lot of families come to us and say, Joe, I'm moving to Florida. How do I create residency in Florida? Well, Andy did that. He's up in Jacksonville, but it gets a little tricky when we have families. Sometimes one of us, is there ways to do it while one of you are still working, or do you have to wait till you're both retired? And what are the rules? Minnesota has been pretty aggressive about going after families that they think should pay some Minnesota tax versus getting away without paying tax in Florida. And we're going to talk a little bit about Arizona and some of the other states out there, but really it's Arizona and Florida, the ones we're going to focus on most because of the tax benefits. While Arizona does have some taxation at the state level, it's where we see a lot of our families that do decide to retire down south. They're going to spend some more time are going. Thursday, April 28th, we are down now to the last 6 weeks. I want to make sure everybody puts this on your calendar. We are going to be doing another one of my large presentations. We've done these a few times. The last couple have been at the DoubleTree. I'm bringing out David Walker. If you don't know who David Walker is, just Google the name. But David Walker was a former U.S. Comptroller General. I'm so excited about bringing him out. We're going to have room for about 200 individuals again, and we're going to be doing this one at the Sheraton there over by Ridgedale. But David Walker, I'm bringing in a former U.S. Comptroller General, and he's going to talk about where he sees things as far as taxes and a whole lot there. More on that, but make sure that you schedule Thursday, April 28th. And if you have somebody that you think would be interested in joining us out there, it's going to be first come, first serve. We've got room, like I said, for only about 200, and we got pretty close to that the last time we did this. And with the social distancing, we used to be able to put 350 in the room. But anyways, we're going to probably have to keep it to about 200. If you want to schedule something, this is the first time we've talked about it. So schedule it. Let us know here at Secured Retirement that you'd like to join us, and let's make sure you save a seat for the 28th. Start time, probably be about 6 or 6:30. Like I think we're doing it at 6:30 start time, but it's going to be at the Sheraton there in Ridgedale. You don't want to miss this. David Walker is really, we're very fortunate to be able to bring David Walker out for that Thursday, the 28th, right after taxes are done. If you need to reach out to us, again, everybody should have a slide there that allows you to schedule some time. If not, you can always just call us at 952-460-3260. There's an email there, info@securedretirements.com, and we'll make sure we answer or schedule some time for a phone call with your advisor, what have you. Does anybody else have any questions? I know that when we start doing this, and oftentimes, Andy, this is the case, is to try to keep this, generic enough that it meets everybody's needs, but also personalized enough that you really get the information that you need to know, because that's 50% penalty. It's the largest that the IRS levies. It's a shame when we see families that end up paying this. About 3 years ago, I had some children of a client of mine come in, and they inherited Roth IRAs. And at that time, you had to take a required distribution. It was before the Secure Act. There's penalties if you don't take a Roth IRA out as a beneficiary too. But now with the 10-year rule, it's a little bit more lenient, or at least gives you more time to figure it out. But if you want to make sure you're avoiding this, or you just want to do some good planning, let's sit down. Let's start to calculate it now. I tell families the best time to start planning for required distributions is before you need to take them. Mm-hmm. So if you are 60 or 62 and don't know these numbers, let's sit down with you so we can start to calculate that into your planning. I say it every time. Families high risk, number one, because they want to maintain their income and spend in confidence throughout their retirement, not worrying about running through their savings. Number two, how do I morally, ethically, legally reduce taxes? Understanding how RMDs come into play is essential to getting that done. And then the third is, well, we're going to help you grow your wealth, but it's never at the compromise of those first two areas, income planning and making sure that you can take it back as tax efficient as possible. So let me see if there was any other questions. Medicare premiums.
There's one on there I saw about HSAs. HSAs do not have RMDs, so you don't have to worry about that when it comes to RMDs off an HSA. You can't keep it in there forever, but there's no required minimum distribution on an HSA and a health savings account like there is on an IRA.
You know, that's a great point, because here's what I always tell families. I think HSAs are the best out there. If I put the money in, it's a tax deduction. If I spend it on a health medical expense, a qualified medical expense, I can take it out tax free. So very, very rarely can we, not pay tax on something going in and not pay it when it comes out. The restrictions we run into is just how much money can get accumulated in these. And the other thing is, because there is no RMD, that's a good thing for retirees. But when you're beneficiaries, if you have children that will inherit these, I always call the HSA the worst asset to inherit it. Maybe I can, because the reason why is that if I inherit a health savings account, all tax on all of that money is due. There's no 10-year rule, no 5-year rule. It all has to be taxed the year the beneficiaries get it. So it's great to have a large HSA, but boy, don't try to pass that on. It's probably better to spend that than it might be other assets in retirement if you are worried about that. So I don't know. Anyway, Andy, I want to thank you for joining us. Any last comments that you have before we sign off this week?
No. I appreciate you having me on. And RMDs. It sounds basic, but there's, like I said, there's ways to get sideways with the rules. Just once you figure it out, just keep on doing it. And if you have to set it up, automatically take it. Set it up to automatically take it. I know the custodians will do their best to calculate it. Here's something crazy. A custodian may not be required to calculate your RMD, but they certainly aren't required to calculate it properly. Some of them require that they do it, but they're not required to do it right. They don't know if you're using a joint life table. They don't know if you're using a uniform lifetime table. So it's good to know how to do the math so you can check their work before they just send you a payment.
Yeah, and a lot of those things that get missed, like the 10-year difference between spouses and such, actually doesn't hurt you, because if you do not use the 10-year, if you're 11 years apart, your required distribution off the other table would be a little bit higher, correct, Andy?
If you're 11 years difference, and you use the 10-year, you use the joint life table, your RMD would be a little bit smaller because you're using a bigger divisor into that balance on 1231. So
it's important that you get the right number. So let's help you do that. If you want to schedule a review with myself or one of the team members here to go over your required distributions, numbers still on the screen there, or you can click on that tab and schedule your own. And everybody else, enjoy the rest of your week. It's Pi Day, 3/14. So maybe sneak out and grab a little piece of pie for lunch here today. One more question. HSA subject to no, Jim, health savings accounts do not have to worry about the RMDs. If you were to have an HSA health savings account, these are different than those flexible spending accounts that have to be used up before the end of the year. They can carry on into retirement. No RMDs for you if your spouse inherits it. No RMD for the spouse, but as soon as it goes to the kiddos or nieces, now whoever that would be, unless it's going to a charity, the beneficiaries have to pay tax on 100% of that HSA balance the year you pass. I suppose there's some exceptions to that, but really they're not a very tax friendly asset. So we encourage families to consider, if you're going to pay a health expense out of a Roth versus HSA, use up the HSA once you get to retirement. So with that said, everybody enjoy the rest of your week, and back next Monday, Nate Zeller again. He's going to be talking about the Federal Open Market Committee meeting. You don't want to miss that, and you should see an email on that. And enjoy the rest of your week. Thanks again, Annie.
Thanks, guys.
Bye-bye.
Bye.